Good morning and welcome to this Monday, December 14th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it looks like we're going to get off to a pretty decent start this morning. We got futures pretty green. Dow Jones and S&P seem to be leading the move, so it might be a little bit more of a push toward the value stocks today, at least at the open. But right now, Dow futures are up 241 points, the S&P up 25 and a quarter, NASDAQ up about 55 points. So on a relative basis, definitely less than what we're seeing on the Dow, but still green is green. Looks like it's going to be a pretty good start to the day. And we shall see what happens, throughout the rest of the week. And as we close out 2020, I don't think anybody is going to be missing 2020 very much. But we still have a few more weeks to get through it. Let's take a look over before I get into anything today. Let's take a look at the our website. Again, for those who are new, I always like to make sure you're aware that we do have a free Earnings Beats Digest newsletter. I tell you, there have been some really, really good stocks that we featured in our digest over the past, well, really since we started the newsletter, but recently there have been some really big winners. I was looking at one, I think it was TTGT, that had come back down close to a support level and then just absolutely exploded to the upside that we had featured probably not more than about a week, maybe a week and a half ago or whatever. But anyhow, it's really designed for an educational purpose. I mean, we're really trying to reach out to folks and just explain how we look at the market and some of the things that we like to focus on in terms of technicals, especially relative strength. We like to look for stocks that are leading their groups. I mean, if you think about how the market operates, Wall Street puts their money into the areas or in the individual stocks that they believe are going to outperform, and nobody has better information than Wall Street. They've got their MBAs that go out and they meet with management teams. They find out what's going on. It's almost like if you follow relative strength and you follow technicals, it's almost like you have your own research department going out and doing things for you. There's a reason why. I know a lot of times you want to buy those stocks that are down, get them, they're 5-year lows. Let's jump in. But there's normally a reason why they're at 5-year lows. Wall Street doesn't like what's going on. They don't like the story that management's telling, or maybe they just don't trust the management team, because management's been so far off in the past. They haven't been able to meet estimates. There's a number of reasons. But anyway, we try to focus on things that hopefully help folks look at the market a little bit differently. And we do publish our EB Digest 3 times a week, Mondays, Wednesdays, and Fridays. Normally, you'll get it before the market opens. All you have to do is put in your name, email address here, hit the subscribe button. No credit card required, completely free. You can unsubscribe at any time. No hassle there. If you don't want to get it any longer, it's fine. We'll definitely scratch you off the list. But I think it's an opportunity to learn some things about the market, maybe incorporate 1 or 2 strategies that maybe you don't already incorporate. You might be a great trader, a great investor, but there still might be something you can tweak. Anyhow, I think you'll enjoy it. Check it out. We've got thousands and thousands of folks on that newsletter. If you want to join Earnings Beats, this is a great week to do it. First of all, we're running an annual special. We only do this twice a year, usually once in the spring, and then normally in the fall. This one ran a little bit later this year. But normally we have our best specials in the spring and fall. And we are kicking off an annual special where if you sign up for an annual deal, which is $697, that's already way below the monthly cost. Monthly, it's $97. So 12 times 97 is 1164. So if you sign up for an annual, normally you're going to go from 1164 down to 697. So you're already saving a bundle. But during this special, we're going to throw in 2 more months for free. So you're going to get 14 months instead of 12. Then we've got our event coming up on Saturday, Market Vision 2021. So David Keller, Chief Market Strategist at Stock Charts, and Grayson Rose, Vice President of Operations at Stock Charts, are going to join me. I think the combination of Earnings Beats and Stock Charts has been unbelievable throughout this pandemic. And I thought, what better way to kick off 2021 than to bring in two of the top folks from stock charts and, of course, earnings beats. And let's get our minds together, talk about what we're looking at in 2021 in terms of products, services, market, everything. I think it's going to be a great event. And if you sign up, if you're an annual member, this event's free coming up on Saturday. So it's just another benefit of being an annual member. The normal price is going to be $197. So if you pay that $697, you're going to get 2 extra months. You're going to get the $197 deal. Now, other members at Earnings Beats, if you're a trial member or if you're a monthly member, you still get $100 off. We're going to knock $100 off. So it'd be $97. So let's say you're out there and you want to come to the event and you're like, okay, well, maybe I'd like to try Earnings Beats and see what's going on. Sign up now. You've got a whole week to see what you think of our service. You don't pay anything. If you sign up for the event, you're going to save $100. You'll go from $197 to $97. And if over the course of the week you decide, hey, this is a great service, I love it, I want to sign up for the annual, you'll get that $697 deal and you'll have a free event on Saturday. So anyhow, I think it's a great deal. I just want to make sure everybody's aware of it. If you have any questions, we'll have a lot more on our website later today. But if you have any questions whatsoever, write into us at support@earningsbeats.com. We'll make sure we take care of you. All right, let's move on to what happened on Friday. Dow Jones Industrial Average finished up 47 points. S&P was down 4.5. The NASDAQ down 28. Mid caps were down 6. Small caps were down 8. So on a percentage basis, small caps actually took it a little bit more on the chin. But every one of these major indices is now trading above the 20-day, which is above the 50-day, and everything's rising. We are in an uptrend. We are in a secular bull market, and we're trending higher. You wake up, you see futures up 240 on the Dow, you shouldn't be shocked. This is what happens in a bull market. The train usually doesn't sit and wait. It just normally keeps going. The other piece of good news that I would say, looking at the market, is that the end of September, the second half of September, is where we usually do the best. I don't have it in front of me, but I did a calculation of the annualized returns for December 16th through the 31st and compared it to annualized returns from December 1st to December 15th. And this is on the S&P 500 since 1950. So we're talking about 70 years worth of December data. The second half of December, the annualized return, again, I might get this wrong, but I think I'll be pretty close. Annualized return, I think, was about 35%. Now, keep in mind the S&P 500 throughout the course of the year, average is going up 9% a year over the last 70 years, roughly 9%. So when you get a period that has an annualized return of 35%, it's essentially telling us that it's 4 times better than normal. I mean, if you have your average annual return is 9%, then if you were studying a period and you're looking for the annualized return, 9% is about what you would expect. Anything above that is better than normal. Below that would be less than normal. The 1st to the 15th, the annualized return is 1%. In fact, we're just getting to the end of a period that tends to be somewhat more bearish for December. Now, we're in a secular bull market. I've been saying that all year, despite the pandemic. You know, back in March, trust me, there were a lot of people thought I was crazy. I got a lot of emails, some of them not nearly as nice as others, but I just was saying what I was seeing on the charts. And there was nothing pointing to this being back in March, even. There was nothing pointing to us having a bear market, a horrible depression ahead. You know, in March, when everything was selling off, growth stocks were leading. How do growth stocks lead if you're heading into a depression? Anyway, the whole market, 2020, I think, has been all part of a secular bull market. I know that's hard to comprehend when you're in the midst of going down 30% in 30 days, but it was all part of a long-term uptrend. Short-term, yes, it was a cyclical bear market. Short-term bear market, long-term bull market. And we see what's happened since. I mean, we've rallied off of those lows on the S&P 500 at 2191. On Friday, we closed at 3663, 1,400 points. And there are a lot of folks out there saying it's too much, too much. We've gone up 1,400 points in 8 months, 9 months. We can't go any higher. Well, keep it in perspective. Where were we before the pandemic hit? We were at 3,200. I don't remember what the 32 and change, 33 maybe. I don't remember exactly. Um, so we're 10% above where we were. We were in a great environment. I mean, market economy is looking very bright ahead and should have, I mean, earnings, you can see a lot of the earnings have been coming in much better than expected. Even the companies that were being hit the hardest are now starting to show better growth, and they're starting to raise forecasts as we go forward into 2021. And all of this comes in the midst of the lowest interest rate environment in our history. I don't want to keep belaboring this point, but just, understand that earnings are worth a lot more when interest rates are at historic lows. I still see articles. It drives me crazy because I just want to get in and have a debate. But when someone writes that PE ratios today are way out of whack when you look at the PE ratios in 2000, I just want to say, well, look at the environment. Look at your choices of investment in 2000. Look at where the yields were on the treasuries. There's a reason why stocks weren't bid up as much back then in terms of relative, PE ratios. There was a reason. Now we've got growth with a low interest rate environment and with the Fed saying they're not going to raise. We don't care if inflation comes out. We're not raising. Anyway, I could go on that soapbox for a long time, but I believe we're going a lot higher. I think this is, it's been a huge run, but it also is just a recovery off of what never should have been lost in the first place. We have a healthcare crisis. We don't have a long-term financial crisis. The market is pricing things based on the future. It's not pricing things based on the news that's happening right now. And that's the disconnect, I think, with a lot of folks that look at the stock market. They don't understand, how can the stock market be going up? The economy's shutting down. That was the thing back in March and April. How are we going back up? We're going to, we got to go back down. We got to retest. We need a double bottom, or the Great Depression's coming. We're going to go a lot lower. That was never in the cards. And if you study beneath the surface action, none of those signals were saying we were going lower. None of them. Consumer discretionary was outperforming consumer staples during the pandemic. How can that happen? Anyway, all right, I'm done. Let's move on. 10-year Treasury yield. Let's see, we didn't have any economic reports out this morning. I will say things will pick up later in the week, especially starting on Wednesday with retail sales. Housing starts will be out on Thursday. So we've got a lot more economic data coming out later in the week. Today, nothing. I think tomorrow might have been one report. I don't recall what it was, but nothing earth-shattering. So we're not really going to see a whole lot driving the market based on economics the next couple of days. And that's probably good, because even though we're looking ahead at things improving, some of the numbers still aren't as robust as we'd like, initial jobless claims and so forth, which will be out on Thursday. But again, the market's looking ahead. The market's not really caring what is happening right now in the economy. And that's, again, a disconnect that a lot of folks, I don't think, understand. 10-year Treasury yield, you can see, let me get a quick update. It was up a few basis points. Yep, still up 3 basis points, 0.92%. I think we're going to go up over 1. I think we're going to test that 1 level, break above it. And then there'll probably be those coming out that say, oh, interest rates are going up. That's bad for the market. Well, not at 1%, they're not. If they're going up and we're at 5 or 6%, then yeah, that historically is a bad area. We could go up to 3%, 4% even. And historically, that's not bad for the stock market. 1% is ridiculously low. That's what I keep talking about, low interest rate environment. Where are you going to park your money? When the stock market hits 4,000, when the S&P 500 hits 4,000 and then hits 4,500, and your choices are to get into the S&P 500 or simply watch the S&P and stick with your 1% 10-year Treasury yield, I just think there's going to be a mass exodus out of the Treasury market in time, over time. It'll send interest rates higher, not a lot, but it'll send interest rates higher, but it's really going to send the stock market higher. So, and I'm going to talk a lot more about that on Saturday when we get into Market Vision 2021. And I'll give you some target level, some things that I'm looking at in the way I think 2021 is going to shape up. All right, keep moving. Wanted to point out the broadcasting and entertainment index. Friday, Disney had a huge day, huge day. They came out, I think they said they're going to be raising their Plus service, or I think that's what they call it, the Disney Plus. The number of subscribers that they have are way ahead of schedule. They're looking at much better numbers, beyond the pandemic. You're going to have their theme parks back. I think later this year, or not this year, but 2021, I think you're going to see, and this is just my own personal opinion. I'm not a healthcare expert, so please feel free to disagree. But I do believe with the vaccines coming out, and I've said this before, I believe, I think it was RBS Securities came out and said that they were looking originally at the U.S. having zero or approaching zero COVID cases by the end of the year. And when the vaccine news hit in November, they upped it and said 6 months, which would be April, May. And I really believe that they're right. I think by April, May, springtime, I think you're going to see very, very few cases. Again, just my opinion. And with that, I think there will be so much pent up demand. I think companies like Disney are going to be swamped. I think there will be tremendous, I think you're going to see raised estimates. I think the stocks are going to go. And when I look at this index, so here's the broadcasting and entertainment index. Now you look at this, and for the last year or so, we went sideways, finally made this breakout, but it's not just a 1 year chart. When I was looking at Disney, I looked at the 5-year chart. I mean, we were at 1,350 back in 2017, got up to about 1,650, had the March pandemic crash there, came back, and now we're just making this breakout. I think we're going to be in for an extended run to the upside. Now, are we maybe short-term overbought? Could we pull back? Yes. Is it worth the risk of waiting to see if we get a pullback before you pull the trigger on a stock like Disney? I think the risk is greater to be out of the stock than to be in it, to be honest. That's just my opinion. And I'm going to show you Disney's chart. It's overbought right now, so you might try to wait. I mean, it had a huge day on Friday, up 13.5%. That's a big, big move on Disney. But you can see the gaps in May, the gaps in August, the gap in November, now the gap in December. Stock wants to go higher. I think there's a lot of demand for the stock. And I think there's going to be a lot of demand for their products and their services in 2021. And when you look at Disney on a longer term weekly chart, you can see pretty much the same thing as I just showed you. I mean, when we went down in March, we were trading at a multi-year low on Disney. And some might say, well, yeah, but the theme parks weren't open, and ESPN and, all of these different things, advertising's down. And okay, yeah, short term, absolutely. I agree with all of that. But longer term, you have to think about beyond the pandemic, beyond the virus, what's going to happen. And I think things will normalize again to some degree. Anyway, Disney is moving higher. I really like the stock. I'm not a registered investment advisor. I say it all the time. I cannot provide anyone investment advice, and you shouldn't take this as investment advice. But I like the stock. It's my opinion. We try to educate. I think if the stock were to pull back into the 155, 160 area, I would really like it there, just from an entry standpoint. So for me, one strategy, and again, you do whatever's comfortable for you, but one strategy for me would be to buy half. And if Disney were to get back to 155, 160, you buy the other half and you average in. That way, if Disney takes off from here and doesn't come back, you've got half your position at least. But anyway, I like Disney. Let's move on here a little bit. And by the way, Disney, we had our Market Vision 2020, and everyone that presented had to give their stock that they liked the best in the Dow for 2020. Mine was Disney. I mean, Disney, was sitting, well, right here, it had made the breakout above this 2019 high. I mean, we go back to the 15-year chart, and you can see back at the beginning of 2020, we had just broken to an all-time high. We were pulling back. I was like, okay, this is great. This is going to be great entry for Disney. And then, of course, the pandemic hit, and we took this big move down. Well, Disney's come roaring back, and now all of a sudden it's starting to look a little bit better. I don't know where it stands versus the other Dow 30 stocks. I'm sure it's behind the tech stocks. and maybe some of the other or some of the consumer discretionary stocks. But Disney is battling back and looks much stronger now. And now that the pandemic's behind us, are going to be behind us, I believe, in 2021. I think Disney will continue to do well. All right, let's move on and talk about transports. So transports continue to break out. This is a 1-year chart again, but we could go to the weekly 5-year chart and you'll see, look at all this sideways consolidation. There's your March, April, well, late February, March drop, and here's your recovery since then. 6,500 to 13,000. We've doubled off the March low on the transportation index. Kind of crazy, really, when you think about it. But as I pointed out back in March and April, this was a game of accumulation distribution. And I say a game, I honestly, I think it was. I think that there was so much hype about the market falling apart. And, you know, when I would look at stocks, half the market would open lower and keep moving lower throughout the day. The other half the stocks would open lower and then move higher throughout the day. It was like this massive divergence, with half the market going down after the open and after a drop down, gap down at the open, and the other half would gap down at the open and then come back up. And you could see it when you looked at accumulation distribution lines on individual stocks or in the industry group sectors. There was a lot of accumulation taking place back in March, which was way different than the financial crisis back in 2008. We were not just getting gap downs, we were seeing massive distribution during the day, selling throughout the day, across the board selling throughout the day. Not what we had in March. Now, I don't have all the intraday data to go back and look at exactly what happened in 1987, but I remember we had some pretty big gap downs, especially Black Monday, October 19th, 1987. Big drop down at the open off the weekend. I'm sure the AD lines probably would have provided us some clues back then as well. But anyway, markets bounce back. You can see transports doubling in the last 8 months, 8.5, 9 months. So that's really good. If you study the market, you look at correlations. One of the things that really drives the stock market, the S&P 500 higher, is when transports are going higher. And that gets back to the Dow theory. I mean, when you've got the Dow Jones Industrial Average and you got the Dow Jones Transportation Average, both moving to new highs, they confirm one another. And that is a very bullish confirmation of a bull market. And so we've got transports going. You know, when we've pulled back, the pullbacks are holding these rising 20-week moving averages. The weekly PPO has moved back to a new high, which is awesome. At some point, we'll have a pullback. And again, I'm going to talk more about that on Saturday. But, because I have thoughts as to when we're going to see a pullback in 2021. I think we'll see one. I don't think it's going to be a cyclical bear market. I don't see a 20% drop coming, but I do see, off of this huge move, everybody getting very bullish. I mean, you can see it in some of the sentiment, especially the equity only put call ratio as more and more money moves onto the call side. We're going to have a period where we're going to have to deal with some of this, and it'll be in 2021, I believe. But again, I'll talk about more of that on Saturday. So anyway, Dow transports, when they're going up, that normally correlates to a very strong S&P 500. So keep that in mind as we move forward. Small caps, where have they been for the last few years? Well, they're starting to rally now. And you can see the small caps making the move here to 1,100. And if we pull up the monthly 15-year chart, 1,100 is the all-time high. Just want to point this out. I mean, we've been seeing small caps doing great, but if we go back and we inspect back, the high in August of 2018 was 1,100.58. The high in September was 1097.13. So August was that all-time high, 1,100.58. Last week, we hit a high of 1,103.95, but we weren't able to close above it, closing at 1086. Watch small caps. I mean, not only have we been moving higher, but I think they're going to lead in 2021. I would want to have some exposure to small caps. If you look at the small cap to S&P 500 ratio, and let me put this up on a better chart. And we get rid of candlestick chart. And let's go back, a few years here. So here's small caps relative to the S&P 500. Now, what I find encouraging is that off of this big drop down to the double bottom here, we came back and we established a high that was higher than this prior high, which was between these two highs. So when I look at a double top, I look at, a double bottom in this case, I look at a low, a high, and then a low. And when you get that double bottom, that high in between those two lows is pretty important, because if you can move back up, you start to make it look like there's an uptrend beginning. Of course, nothing's a guarantee, but that is a signal to me that that double bottom is in. The bottom is in when we see this top cleared. So on a relative basis, we moved to a new high back in June. Now, we did struggle for a few more months, put in another double bottom really right here, shorter term, and then went right back through this high, and then eventually the June high. But look at the relative strength right now in small caps. If you want to outperform the S&P 500 and the small caps are torching the S&P 500 right now, then you want to be at least exposed to the small caps. If nothing else, just some kind of a piece of maybe an IWM or something, which is the small cap ETF, tracks the Russell 2000. I mean, look at it. It broke out over a month ago above all these tops on the daily chart. And the IWM, if we look at the monthly chart, has already broken out above prior highs and is in all-time high territory. So, and you've got different indexes, different small cap indexes, but Russell 2000 looks really good here, making that breakout. And yes, it's overbought. So you could start a position, and if it pulls back a little bit, you could add to it. Maybe, have a plan in place in the event the market does pull back, or in the event on a relative basis that small caps pull back. All right, let's see. As far as, I didn't even look to see earnings today. Probably aren't too many. I looked at it over the weekend. But let me pull up Zacks here and just see. This is where I go. So I go in here, just earnings calendar. And then here you got 16 earnings out today. So just make sure I got those up down here. And then I usually put them in market cap order. Most of these are foreign companies. And then we don't get down to any here in the US until this is $489 million company. So these are very small companies. So in essence, not really a whole lot going on. Tuesday, you can see Nordson, not Nordstrom, Nordson, NDSN. They report, and that's really the only one of any significant size that will be reporting. And then we go to Wednesday. We've got some more bigger companies coming out later in the week. Lennar, I think, is a big one, because home builders tend to do well in December and January, and they really haven't been so far. Interest rates, I think, are hurting them a little bit because we're moving up. Interest rates are still historically low. I wouldn't sell out of home builders just because the 10-year Treasury yield has moved up, quote unquote, up to 0.92%. I mean, mortgage rates right now are ridiculously low. They continue to be low. They're very favorable for home builders. I expect a good report. I just want to see the market react positively. That's the key. So you got Lennar, and then on Thursday, got a couple biggies, I believe. You got Accenture, FedEx, one of our portfolio stocks, been doing very well. I expect a good report out of FedEx. General Mills, Jabil, BlackBerry, so forth. So not a lot of earnings reports coming out, but later in the week, things start to pick up a bit with a couple bigger companies reporting. All right, moving on to, let's go ahead and jump into the 3 you must see and wrap this thing up. First thing I would do is I want to show you is CCXI, which is a pharma. I was intrigued by the AD line, which is up basically to 52-week high, even though stock's been kind of going, a little bit all over the place. The AD line's been strong. Relatively speaking, it's not far from about a 5. I mean, this double peak right here is about a 5-month relative high, starting to turn back up. I noticed the volume. We were trying to break out to a new short-term high on Friday, and the volume, look at the volume pick up there. So all of this was kind of, just making it interesting to me. Pharmas relative to the S&P are picking up, but overall have not been a great group. So this is just one that maybe keep on your radar. It looks like it's trending above the 20-day, so maybe a 20-day test might be interesting on the long side. A breakout above 65 would be very encouraging, though, especially looking at that AD. So that was one stock I wanted to mention. The next one I wanted to mention was one I actually spotted over the weekend when I was just doing some basic research. I love the fact that this stock is back down near its 20-day and near the top of gap support. Anything above that 20 level, 20 and a quarter or so, I think is a really good entry. You got the 20 days at 2060. So if you're in the 20s, stock was just up over 23 a week ago. So if you get this stock in the 20s, let's say it pulls back again later today, I mean, you got the potential for over 10, 11, 12% to the upside, and you could keep a fairly tight stop. So this one I thought looked kind of interesting. And when it did go up and had that huge day, look at the volume on it. This was not a light volume day. Last time we had a big day like this, I'll annotate this for you. I want to show you something. I thought this was very interesting. The last time we had a really big day on volume, look at this big hollow candle. All the buying started right here on this gap up to here. Look at where we went down to the low. 2.5 months later, went right to where everybody was buying on that heavy volume day. And all of a sudden, buyers came back in. So anybody buying up here, 17 and change, probably really upset with the stock a month later at 12 and a half. And this is what happens in the stock market over and over and over and over and over again. I can promise you that that was, while nobody else wanted to buy and everybody's getting frustrated, especially those buying at that top, I can pretty much assure you market makers were accumulating throughout the downtrend, all the way down. Because institutional investors are much more patient than retail investors. Institutional, if they're buying, in this price range and the stock is up here 3 or 4 months later, that's fine. They don't care. They're happy with that move. Individual traders, if a stock's at 14 and next thing you know, it's at 12, 3 weeks later, can't deal with that kind of, it's emotional toll. And a lot of times just get out. And look at that hammer. Got some buying came in right off of that low, or excuse me, that gap up right there. So now you got the same thing, very heavy volume, gap up. Look, we went back down the very next day, went just below. Buyers came in, went back to a new high. Now we come back down, getting close. Anyway, spent way more time on that than I should. But I like the stock. I think it's interesting. It's in an area, by the way, if I go to this relative strength, you can see this is an area of technologies doing very well right now. And this stock has been doing very well relative to its peers. Just at its high, it was at a 52-week relative high. So this is a strong stock in an improving area, and it's down near the 20-day moving average. That doesn't guarantee us anything. I'm not saying please don't go to the water cooler and say, you know what, Tom Bowley promised me that this stock was going to go higher, and it didn't. I don't have a crystal ball, but I like a stock like this. And if I'm going to lose money, I would rather lose it on a stock that looks good to me across the board. And I think this one looks pretty good. Next up, LIVX. It's going to be our final 3 you must see, and we'll take a look at the market and wrap this up. LiveX, Live Media. This is a stock that I had looked at back before when it was really strong. Then went through this period of just constant downtrending. Well, that broke. And as it broke, volume picked up at the end of November, came back down. We held the 20-day moving average, and now we're breaking out again. So definitely doesn't look like this downtrend's in play anymore to me. It looks like we're uptrending. Like the volume that came in on Friday, I think there's more and more interest. Might get another chance on a pullback near the 20-day. This is going to be a pretty volatile stock, so it's not going to be for everybody. If you have a weak stomach, I would say stay away. If you have a strong stomach or you really like to take risks, you like these small stocks, I think anything back down in the 250, 260 range certainly improves your reward to risk on the trade. But I like the stock. I think we're going to make a run up to that 325 level at least. That's where we've kind of failed the last couple of times. So that's what I'd be looking for there. All right, see what's going on in the market here. Yeah, we got a great day across the board here. Dow up 216, S&P 23, NASDAQ 86. So NASDAQ has closed that ground and now is performing as well as the Dow, which is good. I like to see everything going up. VIX, which had climbed last week, coming back down. Another telltale sign to watch for here is the VIX closing below 20. It's been working its way down. All of its pops to the upside keep getting lower and lower, but a move back below 20 is really going to begin to signal that we are in for a boring bull market ahead. So watch the VIX. But overall, great action. You see small caps, mid caps outperforming again today. That's good. And I'd like to see that continue. Looking at the Dow and the top stocks, Boeing all of a sudden is back on track. I think, again, market looking beyond all the issues. Boeing looks much stronger. Caterpillar looks much stronger. McDonald's had been going down. We'll have to, kind of wait that one out and see if it can begin to show leadership again. Goldman Sachs has been doing much better, although I like Morgan Stanley better. Travelers, after the big gap up earlier, has been going sideways for the last month or so, maybe last 5 weeks. Watch for a breakout there. And we can go right down the line, but we're out of time. So listen, everybody have a great day. Remember, go over to Earnings Beats, check out, we'll have it up on the site later. Make sure that you reserve your spot for Saturday's Market Vision 2021. Again, if you are an annual member, it is a free event, free. And we're running an annual special. So go in, sign up, become an annual member for $6.97. You get 14 months instead of 12, which works out to $50 a month. Normally, our monthly rate is $97. So you're talking about 50% off, and you're going to get this event coming up, plus, the 2 bonus months and all. So anyhow, it's a great deal. Make sure you sign up for that. Again, if you have any questions at all, write us at support@earningsbeats.com, and we'll be happy to get back to you. Everybody have a great day. Be back tomorrow over at Stock Charts for your next Trading Places Live. Happy trading, everybody.